A Random Walk Down Wall Street, The Best Investment Guide That Money Can Buy. By Burton G. Malkiel. I will convey essence of the book, How to Use the Random Walk Investment Method to Steadily Grow Your Investment Returns in the American Market. In 1593, a botany professor brought tulips from Vienna to Leiden in the Netherlands. The Dutch were fascinated by this flower and began investing in it frantically, causing tulip prices to soar for over 30 years. By January 1637, the price of tulip bulbs had increased 20-fold. However, this was the last frenzy. A month later, tulip prices crashed, and the decline was faster than the rise, quickly falling to worthless levels. Does this story sound familiar? In fact, that tulip mania centuries ago was the first financial crisis in world history. Since then, similar investment stories have repeated themselves, like the 1929 Wall Street crash, the early 21st century U.S. real estate bubble and subprime mortgage crisis, and the stock market crashes in 2008 and 2015. How can we avoid investment traps and achieve stable returns? This is the question every investor is most concerned about. The book we're discussing today, A Random Walk Down Wall Street, answers this question. The book's title suggests a random walk down Wall Street, which on the surface means walking leisurely on Wall Street. However, it also hints that using the random walk investment method is the way to invest easily and comfortably. From the title, we can also see that this book's investment strategy mainly targets American investors, but worldwide investors can also learn from it. So what is a random walk? Originally, it is a mathematical statistical model used to represent irregular movements. It is now applied in many fields, such as ecology, economics, and psychology. In the field of economics, a random walk simply means an investment method that respects the randomness of market movements. The author of this book, Burton G. Malkiel, suggests that investors use the random walk investment method to more likely achieve steady growth in their investment returns. A Random Walk Down Wall Street is a highly renowned book. Forbes commented that, in 50 years, there are fewer than 5 or 6 truly great investment books, and A Random Walk Down Wall Street is one of those classics. So who is the author of this investment classic? The author, Burton G. Malkiel, is both a scholar in finance and an experienced investment manager. He has served as the director of the Financial Research Center and the chair of the Economics Department at Princeton University, as well as a member of the President's Council of Economic Advisors. He later became the dean of the Yale School of Management for 8 years. Malkiel, who moved effortlessly among prestigious institutions, also held key positions at several investment companies, including the famous Vanguard Group and Prudential Financial. Having introduced the book and its author, let's delve into its content. First, I'll explain why technical analysis and fundamental analysis cannot predict the stock market. Then, we'll discuss how to overcome market randomness, the biggest enemy of our investments. Finally, we'll talk about how to choose the right random walk investment method. Let's start with the first key point: why can't technical analysis and fundamental analysis predict the stock market? Malkiel believes that the market is random, and short-term fluctuations in stock prices cannot be predicted. The so-called stock price predictions, company earnings forecasts, and complex charts are useless for selecting stocks. In other words, a blindfolded monkey randomly picking a portfolio of stocks would do as well as the so-called market experts. Professional investors naturally refute this by claiming they can perform technical and fundamental analysis. But can technical and fundamental analysis really predict the stock market? First, let's look at the once popular technical analysis. What is technical analysis? Essentially, it involves drawing and interpreting stock charts to predict price changes. Why do many people find it useful? Technical analysts believe that all information relevant to a company's earnings, dividends, and future performance is automatically reflected in the company's past stock prices and trading volumes. Since stock price changes follow certain trends, technical analysis is deemed necessary. Moreover, they think only 10% of the stock market can be understood logically, while the remaining 90% should be analyzed psychologically. They believe that by studying charts, it is possible to understand the future actions of all market participants, which would allow them to grasp market trends, as an item's value equals what people are willing to pay for it. Because of their obsession with the psychology of market participants, technical analysts often go beyond studying price changes and create absurd correlations. For instance, the famous hemline index theory suggests that when women prefer wearing miniskirts, a bull market is imminent, and when they prefer long skirts, the market will slump. This theory seemed effective before World War II but lost its predictive power afterward, as women's skirt preferences did not consistently precede bear markets. In the face of market randomness, Malkiel believes that using technical analysis is very risky because historical stock prices have no reference value for future prices, and there is no trend in the stock market. Instead of relying on chart analysis and frequent trading, it is better to buy and hold stocks for the long term. At least this reduces transaction fees. Since technical analysis is not very helpful for investing, is fundamental analysis reliable? Malkiel is skeptical about this as well. What is fundamental analysis? In short, it involves analyzing a company's true market value, such as its current performance and profitability, to predict its future stock price movements. This logic seems more reasonable than technical analysis. In fact, most professional analysts on Wall Street are fundamental analysts who make investment decisions based on their understanding of companies. While understanding a company's situation and true value is certainly good, does fundamental analysis really work? This question can be easily answered by looking at the performance of securities analysts. Many studies have found that professional analysts' managed funds do not perform better than unmanaged large-cap stock indices. In other words, paying professionals for fundamental analysis and investing based on their advice yields returns similar to random stock selection. Although some funds perform well during certain periods, their performance is not consistent. In the 1990s, the Wall Street Journal launched a dart-throwing contest where 4 Wall Street expert stock picks competed against randomly selected stocks, and their performance was comparable. Why is this? Fundamental analysis seems reasonable. Isn't stock price determined by company value? Malkiel points out several factors that affect the accuracy of fundamental analysts' predictions. First of all, many important changes affecting a company's profitability are inherently random and unpredictable. For instance, Wall Street's forecasts for the high-tech industry in the early 21st century were grossly inaccurate. Investment bank Goldman Sachs predicted in mid-2000 that there was no long-term risk in the internet sector. However, within months, hundreds of internet companies went bankrupt. Other unforeseen events like management failures, the emergence of significant new products, major natural disasters, and accidents can also cause seemingly promising companies' stock prices to plummet. Moreover, companies' fraudulent practices can affect stock price predictions as they often produce unreliable financial reports. Malkiel likens a company's profit statement to a bikini. The part that's revealed is eye-catching, but the hidden part is more important. In the late 1990s bull market, many companies boldly fabricated lies to make their financial reports look good. Even renowned companies like Kodak, Xerox, and Motorola engaged in financial data manipulation. When analysts work with falsified reports, they are essentially looking at misleading data, making it impossible to predict stock prices accurately. Finally, humans make mistakes, and analysts are no exception. Good analysts often don't stay in research roles because their salaries are lower than those of salespeople or fund managers. Furthermore, conflicts of interest between research departments and investment banking departments can compromise analysts' objectivity. That covers the first key point. Next, let's move on to the second key point: how to overcome the biggest enemy of investment, market randomness. Through the previous analysis, we already know that technical analysis and fundamental analysis are not very reliable. So what should investors do? Malkiel suggests taking a middle path. While technical analysis is unreliable, its theoretical foundation, that public psychology influences stock prices, holds some truth. As for fundamental analysis, while it can hardly predict the future accurately, understanding the basic situation of an industry and a company can give you a basic judgment about stocks, despite being affected by randomness. Since we know randomness is the biggest characteristic of the stock market, why not devise the most effective investment method based on this principle? Academia, through long-term research, has created some new investment techniques. These investment techniques might help us achieve higher investment returns while reducing investment risk. So, what should we do specifically? For everyone wanting to reduce risk, a diversified portfolio investment strategy can be chosen. The mathematical principle of this theory is complex, but we can illustrate its principle with a simple example.
Let's assume we live on a deserted island where there are only two companies. One like Hilton Group, a large hotel resort group operating beachfront, tennis courts, and golf courses, and the other is an umbrella manufacturer. It's clear that different weather conditions will affect the performance of these two companies. On sunny days, the hotel group thrives while umbrellas are neglected. On rainy days, the opposite happens. We assume that on sunny days, the umbrella manufacturer's return rate is minus 25%, and the hotel group's return rate is 50%. On rainy days, the reverse is true. On average, half the year is sunny and half is rainy. If an investor only buys the hotel group stocks, half the year they can expect a 50% return rate and the other half a minus 25% return rate, resulting in an expected annual return rate of 12.5%. If they buy the umbrella manufacturer's stocks, the expected return rate is the same. However, this is an expected return rate if the island's weather isn't exactly half sunny and half rainy, but more sunny or rainy, their return rate changes. In other words, they face more uncertainty, which is risk. But what if they divide their funds equally between the two stocks? We can find that regardless of weather changes, their return rate will be stabilized at 12.5%. This way, their investment risk is reduced. Although they might not gain higher returns from weather changes, at least they won't lose this 12.5% return. This example shows that by diversifying investments, we can effectively reduce risk. Malkiel says diversification also has its critical point, which is 50 stocks. That is, spreading all your money across 50 different stocks can reduce risk by over 60% compared to buying just one stock. But buying 50 various stocks versus buying 500 stocks doesn't make much difference in risk. In practice, the lowest risk portfolio consists of 17% foreign stocks and 83% US stocks, and this combination also tends to increase portfolio returns.
Diversified investment helps us reduce part of the market risk and can even increase returns at times. This principle helps us develop our investment plan. Besides diversified investments, we should also avoid irrational behavior to avoid pitfalls. Before investing, we should understand some of the investment behaviors of people. Traditional economics often assumes that investors are rational when creating economic models. However, more and more financial scholars find that many investor behaviors are far from rational. These irrational emotions and behaviors include overconfidence, judgment bias, herd behavior, loss aversion, regret, etc., all of which can affect stock prices. Take herd behavior, for example. In the 1950s, social psychologist Solomon Asch conducted an experiment where he asked 7 participants to answer a simple question that even a child could get right. However, he had 6 of them give the wrong answer first. It turned out that the 7th participant often also gave the wrong answer due to social pressure, even if they knew it was incorrect. Asch speculated that even knowing the answer was wrong, social pressure would still make people conform. Such situations in the stock market can be disastrous. The tulip mania we mentioned earlier and the early 21st century dot-com bubble both had elements of herd behavior. What's particularly scary is that such effects not only happen to ordinary people but also to professionals. In other words, professionals might also go with the flow rather than basing their choices on research results. In 2000, a large amount of stock fund capital flowed into high-tech growth funds, leading to substantial losses over the next 2 years. Behavioral finance scholars, through historical reviews, have summarized lessons and offered advice based on people's irrational behavior. The most important lessons include: avoid following the crowd, avoid overtrading, if you must trade, sell losing stocks rather than winning ones, and don't believe in foolproof strategies. In conclusion, this part explains the importance of a diversified portfolio, avoiding irrational behavior, and understanding that market information reacts effectively. Malkiel's new investment techniques aim to help us tackle randomness, the greatest enemy of investment. Finally, let's talk about the most crucial point: how exactly should you invest in a random walk? The easiest way to invest in a random walk is through dollar-cost averaging into index funds. As we've mentioned, even professional funds and experts don't have lower risk and higher returns than index funds. So why not just buy index funds directly? While this is true, it doesn't mean you should buy a lot all at once. If you buy at a market peak, even index funds won't save you. Therefore, it's best to use dollar-cost averaging, buying regularly over a long period, as this is an effective way to reduce risk. Generally, the longer an investor holds stocks or funds, the less volatile the investment returns will be. Of course, we also discussed earlier that diversified investment is an important way to reduce risk. Malkiel also provides a diversification example. He suggests that people in their 50s allocate about 5% of their assets to money market funds, 27.5% to bond index funds, 12.5% to real estate investment trust (REIT) index funds, and 55% to stock index funds. Among the stock index funds, 27% should be U.S. domestic stock index funds, 14% should be developed countries stock index funds, and 14% should be emerging markets stock index funds. If you don't believe in index funds and want to buy stocks directly, you can also use the hands-on random walk method, selecting and buying stocks yourself. However, there are some rules worth noting. Although you can't rely solely on fundamental analysis or technical analysis, you can combine them. When choosing stocks, it's best to select companies whose profit growth seems to exceed the average for 5 consecutive years, as well-performing companies are more likely to be reliable. This is fundamental analysis. Additionally, if a company's chairman is particularly good at storytelling and can inspire people's imaginations based on his stories, that can also be a good sign. As we emphasized earlier, stock prices are indeed influenced by public psychology. This is technical analysis. The book also reminds us that no matter how well a company performs, you should never pay more than its actual value. For instance, we all know that Apple is doing very well, and its current stock price is over $100, which we assume is its current reasonable value. If its stock price suddenly rises to $1,000 tomorrow, you should think about whether this price exceeds its reasonable value before buying. Moreover, once you have thoroughly researched and decided to buy, you should minimize trading. This can reduce fees and taxes, and long-term holding can also reduce risk. Another popular saying on Wall Street is worth noting: keep the winners, sell the losers. If you can combine fundamental analysis and technical analysis well, wandering through the stock market on your own is also a good option. Of course, if you find an exceptional random walker, like Malkiel himself, and trust his integrity and ability, you can leave everything to him. But as mentioned earlier, professional fund managers' returns are often inferior to index funds. So, this method is for reference only.